Hello, everybody. My name is Yaman, and I provide daily updates on markets and technology. Let's get started. Markets are drifting lower a little bit, but they're generally flat. Russell 2000 up 0.7%. Oil prices are at $58. We're going to talk about that. Yield curve is up a couple basis points today. You can see some of the stocks are changing quite a bit. Nvidia is positive. Bank of America, we're going to talk about that, up 4%. Morgan Stanley up 5%. And AMD is up 7%. Let's move on to daily article. Wall Street advances after strong bank earnings, chip stocks rally. Wall Street's main indices rose on Wednesday after solid results from Bank of America and Morgan Stanley, while chip makers climbed as ASML reported strong quarterly results. Morgan Stanley's shares hit a record high and were last up 7%, while Bank of America rose 4% after the top lenders beat Wall Street estimates for third quarter profit on deal making strength. Bank of America also raised the lower end of its interest income forecast range. We've seen really good results from big banks that have reported thus far. Some impressive beats there, but so I would expect that we'd see positive sentiment and a good market reaction, said Christina Hooper, Chief Market Strategist at Man Group. Meanwhile, U.S. Treasury Secretary Scott Bessent said at a CNBC event that the wave of investments into the U.S. economy is sustainable and is only getting started. A day earlier, lenders including Goldman Sachs and JP Morgan Chase reported solid performance in investment banking and predicted that the business would continue to boom. U.S. chip makers rose after ASML reported third quarter orders and operating income above market expectations. U.S. listed shares of ASML advanced 3%. Micron added 1% and AMD rose 7%. Intel and Nvidia added 1% each. NASDAQ gained 1.2%. We talked about that. A slate of Fed officials are set to speak later in the day. Fed's beige book of economic conditions due at 2 p.m. is also on the radar. Fed Governor Stephen Miran at the CNBC event said 2 more cuts this year sounds realistic, noting that the labor market has clearly weakened. We're going to talk about that as well. Fed Chair Jerome Powell left the door open to rate cuts on Tuesday by saying the labor market remained mired in low hiring, low firing doldrums. Bessent also said CNBC he plans to present 3 or 4 Fed chief candidates to President Trump for him to re-interview sometime after Thanksgiving. Meanwhile, Trump on Tuesday said Washington was considering cutting some trade ties with China, including in relation to cooking oil. That came after the two countries began imposing tit-for-tat port fees, adding to concerns about the China-U.S. trade war. Bessent said officials from both countries are working to set up a meeting. Among other stocks, Abbott declined 3% on downbeat quarterly revenue. Progressive lost 8% after the insurer reported third quarter results. Bunge rose 11%, despite the company lowering its 2025 earnings forecast following its merger with Viterra. Advancing issues outnumbered decliners by 3-to-1 ratio on NASDAQ. Let's focus on NVIDIA. BlackRock NVIDIA-backed group strikes $40 billion AI data center deal. An investor group including BlackRock, Microsoft, and NVIDIA is buying one of the world's biggest data center operators with nearly 80 sites in a deal worth of $40 billion to secure coveted computing capacity for AI. Interesting. The purchase of US-based aligned data centers from Australian Macquarie Asset Management on Wednesday is the first deal for the AI infrastructure partnership formed last year, which also includes Abu Dhabi-based fund MGX and Elon Musk startup XAI among its backers. With this investment in aligned data centers, we further our goal of delivering the infrastructure necessary to power the future of AI, said BlackRock CEO Larry Fink, who also serves as the chairman of the AI Infrastructure Partnership. The acquisition is the latest in a series of big-ticket deals from big tech and Silicon Valley startups that has been fueled by the boom in AI. Major tech companies, including Alphabet, Amazon.com, Meta, Microsoft, and CoreWeave, are on track to spend $400 billion on AI infrastructure this year, Morgan Stanley estimates. OpenAI, the startup at the heart of the AI boom, struck deals in recent weeks with chip makers NVIDIA, Advanced Micro Devices, and Broadcom that may cost over $1 trillion to secure about 26 gigawatts of computing capacity, enough to power roughly 20 million US homes. Meta Platforms is building several multi-gigawatt AI data centers, including one called Prometheus, due to come online in 2026, and another Hyperion that can scale up to 5 gigawatts. Privately held Align Data Centers currently has over 5 gigawatts of operational and planned capacity located across 50 campuses in the US and Latin America. Interesting. Why do they have to buy that one? That's the like, why buy, not build? Currently there's a 5 gigawatt operational planned capacity across 50 campuses. 5 gigawatts. $40 billion deal. $80 sites. Okay. 50 campuses. Interesting. Okay. Joe Tigay, PM of NVIDIA shareholder Equity Armor Investments, said the acquisition highlights the growing value of data center assets for investors. They're looking at rapid expansion to meet AI demand and optimize for it. Aligned has been a big winner of the AI infrastructure spending boom, raising $12 billion in equity and debt earlier this year in one of the largest private capital injections into a data center company. Shares of its publicly listed rivals, such as Applied Digital, have soared more than fourfold this year. Applied Digital shares jumped 5% on Wednesday. I'm going to look into these companies. Interesting story. The investment group buying Align also includes Kuwait Investment Authority and Singapore state-owned investor Temasek as anchor investors. It has an initial target of deploying $30 billion of equity capital, with the potential of reaching $100 billion, including debt. It has not disclosed how much each partner has contributed to the tie-up or the equity value of Wednesday's deal. NVIDIA and Aligned declined to comment, while investors did not immediately respond to requests seeking more details on the deal. Aligned will remain headquartered in Dallas, Texas, under CEO Andrew Schaap. When the deal closes in the first half of 2026, the investor group said in its statement. Applied Digital, Aligned. Okay. Wall Street boom boosts profits at Bank of America, Morgan Stanley. Third quarter profits at Bank of America and Morgan Stanley surged 23% and 45% respectively, as the banking giants became the latest to benefit from a Wall Street deal-making boom. Bank of America posted net income of $8.5 billion, while Morgan Stanley reported $4.6 billion. Both figures were more than $1 billion higher than what analysts saw coming. Big reason for that performance is a frenzy of mergers and IPOs that surged through the summer. Deal-making fees at Bank of America and Morgan Stanley surged 43%, 44% respectively from a year ago to $2 billion and $2.1 billion. Trading also did well as markets moved higher. We talked about this quite a bit yesterday. Morgan Stanley's haul from its combined equity, fixed income, currency, commodity trading ballooned to $6.3 billion. CEO said the quarter was outstanding, strong fee performance from our market-facing businesses. The results reinforce what is shaping up to be the robust third quarter for big U.S. banks with sizable Wall Street operations. Bank of America took the highest paid investment banking role in Union Pacific's agreement to purchase Norfolk Southern for $71 billion, which was announced in July. This mega combination of two major U.S. railroad operators was the single largest deal so far this year. Morgan Stanley also advised on that deal, also facilitated the Keurig Dr. Pepper acquisition of JDE Peet's. Okay. All right, same story as yesterday, basically. Trump leverages U.S. shutdown to make unilateral spending moves. President Trump has, in the span of just 4 days, fired thousands of government employees, transferred billions in federal funds, and threatened to unilaterally cancel Democrat programs, all during a shutdown and without Congress's approval. The moves playing out against the backdrop of a standoff over federal spending now entering its third week mark an escalation of the administration's efforts to use the federal budget to centralize power. Republican congressional leaders have so far largely backed the White House's expanded power claims, asserting that Trump has wide ranging authority during a shutdown to pay military personnel and make other necessary moves in the absence of new federal funding. Speaker Mike Johnson, who has kept the House out of Washington as Senate Democrats blocked the spending bill his chamber passed, said Wednesday that he recently spoke with Trump's budget director, Russell Vought, about efforts to triage federal spending to pay priorities. They are forlorn, Johnson said of Trump and Vought, who Republicans have gleefully portrayed as a sort of budgetary Grim Reaper and his staff. Yet the moves have prompted lingering questions about the legality of the administration's approach. No other president in modern history has tested the bounds of executive authority during a shutdown to the extent that Trump has in the last 2 weeks. Many of these things certainly look legal unless they have a very complicated theory going places that I have never imagined, said Georgetown law professor David Super. Okay. Super said existing transfer authority doesn't allow Trump to pay the troops with leftover research funding, while spending money to conduct layoffs is illegal because that activity isn't essential to protecting life and property. Trump has already used the shutdown to freeze infrastructure projects in states that voted Democratic in last year's presidential election, while his administration has changed agency websites and out of office emails to blame radical left Democrats for the shutdown. Rather than consult Congress as required, excuse me, to move around $8 billion in defense funds to make military payroll, he did so on his own. On Friday, the president is expected to release a list of programs favored by Democrats that he intends to terminate. I think this is going to end before the end of October. That's my guess. Apple debuts new M5 chip alongside upgraded 14-inch MacBook Pro and iPad Pro. Apple on Wednesday announced its new M5 processor, which it said offers improved AI performance in both its latest 1600 MacBook Pro and 999 iPad Pro. Apple said the chip, the company's most recent homegrown processor, includes an upgraded CPU and a 10-core GPU with neural accelerators in each core. That, Apple said, means the M5 provides 4 times the GPU compute performance compared to the M4 and 6 times compared to the M1. Graphics performance is 35% faster than the M4 and 2.5 times faster than M1. This is interesting. M5 provides 4 times GPU performance compared to M4 and 6 times compared to, so it's a big jump in terms of GPU compute performance from M4 to M5 compared to the progress from M1 to M4. That's okay. That the company said works out to 3.5 times better AI performance than the M4 equipped MacBook Pro and iPad Pro. The 14-inch MacBook Pro also gets up to 32 gigabytes of higher bandwidth memory and faster storage, which should add up to a speedier overall feel compared to prior generations of the laptop. As for battery life, Apple claims the M5 powered 14-inch MacBook Pro will last about 24 hours on a single charge. New iPads are also first to come with Apple's custom C1X cellular model and N1 Wi Fi and Bluetooth chips. Physically, the iPads are the same as their predecessors, so don't expect the kind of flashy refresh. Okay. Apple is clearly positioning its latest chip and products as an AI powerhouses for developers and users alike. It's part of the broader industry push in the PC space to telegraph to customers that their devices are more than capable of handling certain AI tasks. Microsoft and its Windows partners are making a similar push with their AI PCs. And while the companies align angling to get more recent MacBook and iPad users to upgrade to its newest hardware, it's also trying to entice older MacBook users with Intel powered systems to make the jump to its latest laptops and tablets. In 2024, the Mac business generated $30 billion in revenue, while the iPad segment brought in $27 billion. The iPhone, however, saw $201 billion, and services raked in $96 billion. Okay. Switching to macro. A good segue from micro to macro. Amazon is planning a new wave of layoffs, sources say. Amazon is preparing to cut as much as 15% of its human resources staff, with additional layoffs likely in other divisions, according to multiple sources familiar with the plans. Two sources told Fortune that Amazon's human resources division, known internally as PXT or the People Experience Technology Team, will be hard hit, but that other areas of Amazon's core consumer business are also likely to be affected. It couldn't be learned how many employees in total Amazon plans to let go, nor the exact timing of the cuts. I'm guessing more than 1,000. Yeah, 1,000 to 2,000. Thousands, let's say. The company laid off relatively small numbers of employees earlier this year in areas such as its consumer devices unit, its Wondery podcast division, and Amazon Web Services. Amazon's PXC division, which reports to Senior Vice President Beth Galati, has more than 10,000 employees worldwide and includes a large recruiting team, plus technology staff and other traditional HR roles. The new cuts come as Amazon continues to look for ways to lower employee costs while investing aggressively in AI products and infrastructure, both for internal use and to sell to enterprise customers. The company has said it intends to devote upwards of $100 billion to CapEx this year as it builds out its cloud and AI data centers. Amazon's CEO Andy Jassy already oversaw the largest layoffs in company history from late 2022 into 2023, when the company cut at least 27,000 corporate jobs, which accounted for a high single-digit percentage of the company's office jobs. Interesting. Many other big tech companies also slashed their headcounts around that time as the pandemic receded and consumer demand trends changed. Now, many employers are looking to harness the power of AI initially for mundane and repetitive tasks, eventually for more complicated jobs to reduce the need for maintenance, blah, blah, blah. Jesse himself is one of them. CEO fired a bit of a warning shot to his own employees in June when he encouraged them to welcome this new AI powered era. Those who embrace this change, become conversant in AI, help us build and improve our AI capabilities internally, and deliver for customers. We'll be well positioned to have a high impact and help us reinvent the company, he wrote in a company wide email. At the same time, Jess also made a point to note that there won't be room on the bus for everyone. We expect that this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company. There you go. So it's not just attrition, layoffs are coming. It's one of the largest employers in the United States. I think it's like a top five, if not top three employer. Oil prices dip, stay near 5-month low on US China trade tensions, looming supply surplus. We talked about this yesterday a little bit. They're still slipping. Oil prices dipped on Wednesday, holding near a 5-month low for a second day, pressured by escalating US China trade tensions and the IEA's prediction of a supply surplus in 2026. Let me just see if there's anything new here. Deflationary pressures persist in China. I don't think that's true. I think the CPI is positive, actually. It's like 1%. With both consumer and producer prices falling in September as a prolonged property market slump and trade tensions also weighed. In the US, investors are becoming more convinced that the Federal Reserve will keep cutting interest rates. On Tuesday, Fed Chair Powell, we talked about that, Russia's two largest oil companies, Lukoil and Rosneft, and 51 shadow fleet tankers in what is described as a new bid to tighten energy sanctions and choke off Kremlin revenues. Azerbaijan oil output fell by 4% to 20.7 million metric tons in January September from 21.6. Okay. Okay. Not much neither. Let's go to Powell. He spoke yesterday. Fed's Powell addresses economy pulled between risks to growth, jobs, and prices. Fed Chair Jerome Powell on Tuesday delivers his last scheduled remarks before the Fed's next meeting, with the economy enjoying stronger than expected growth and a recent jump in productivity, but still adjusting to tariff and immigration policies that economists worry could lead to both higher inflation and higher unemployment. Challenging for a central bank responsible for keeping inflation low and employment as high as possible, Powell and his colleagues are also facing a drought of official data amid a US government shutdown that has delayed, this is the wrong wording, responsible for keeping inflation low and employment as high as possible. That's the wrong wording. Howard Schneider. Powell and his colleagues are also facing a drought of official data amid the US government shutdown that has delayed the September jobs report and other key statistics. An update on consumer prices is now scheduled for October 24 before the Fed's October 28-29 meeting. Investors expect the Fed to lower its benchmark interest rate by a quarter of a percentage point to the 3.75 and 4% range, and then lower it again in December. But the competing forces in the economy right now have become tangled, said EY Parthenon chief economist Gregor Dacko. There are conflicting forces that are affecting the U.S. economy, in particular with the U.S. economy essentially being constrained by tariffs, also by reduced immigration, Dacko said at the meeting of the National Association of Business Economics Conference, where Powell speaks on Tuesday. At the same time, we're seeing a great spoke on Tuesday. What is the date of this? Oh, this is from yesterday. At the same time, we're seeing a great deal of investment on the AI front. These forces are offsetting one another, not necessarily proportionally, not necessarily at the same time, but I think it's a very interesting duo. How fast the tension resolves into a more consistent view of the economy will be crucial for coming Fed decisions. Policymakers are divided between those concerned that inflation remains above Fed's 2% target and is expected to remain stuff. Someone's got to give, Fed Governor Waller told CNBC last week. He noted the contradiction between economic growth estimates getting revised higher, nearing 4% for the third quarter, according to Atlanta Fed's GDP Now model, and the job market that seems in the doldrums, with a recent report from payroll processor ADP showing the economy lost jobs in September. Okay. You can't have negative job growth and 4% GDP growth. Either the labor market rebounds to match the GDP growth or GDP growth is going to pull back, said Waller, who favors further rate cuts to protect the job market, but says those should come in cautious quarter point moves to avoid a mistake. The Fed's quarter point reduction in September was framed as a way to balance potential strains on the job market while still leaving rates high enough to maintain downward pressure on inflation. In the absence of September jobs report, officials like Waller have noted that an array of private sector indicators have pointed to weak hiring, even if none of on their own is a perfect substitute for BLS's monthly surveys of businesses and households. At the same time, the last reported unemployment rate of 4.3% in August remained near what's considered full employment, and the Chicago Fed estimate of the September rate indicated it did not change much, if at all. But coming months could prove important in understanding the impact of President Donald Trump's policies, from still evolving tariffs to immigration restrictions to tax changes. Surveys of corporate executives, company earnings reports, and other data have painted a consistent picture of an adaptation still underway. Firms may have absorbed much of the tariff impact so far by cutting costs or trimming profits. I don't think either of those things happened. A dynamic economist said could be driving short-term productivity improvements while the longer-run payoff of AI investment is still developing, but also that price increases are in the pipeline for next year. Forecasters surveyed by NABE, for example, see inflation by the Fed's preferred measure remaining at 2.5% through next year, while analysts, including Karen Deanon, a Harvard University economist and a senior fellow at the Peters Institute for International Economics, see it rising even higher, in her case to around 3.3% through 2026, as tariff costs are increasingly passed along to consumers. Given recent years of above target inflation, I think there's a good chance inflation expectations become unanchored. And if that proves to be the case, the Fed cuts, and I do expect several more, are going to be seen as a mistake, she said. The counter argument of a budding productivity boom that could add to growth without rising prices can't be discounted, the Philadelphia Fed President Anna Paulson told NABE conference. She says she's already concerned the aspects of the economy supporting growth have narrowed to a few, such as AI investment and spending among higher income consumers. Quote, I don't want to step on productivity boom. I don't want to step on a productivity boom, said Paulson, who described the current outlook for 2 more quarter point rate cuts this year as appropriate. I don't know what that means. I don't want to step on a productivity boom. Again, stop it. Okay. Growth continues, but rests on a relatively narrow base, she said. Indeed, some business contracts are wondering where future demand will come from. Business contacts. Okay. All right. From Powell to Mirren. Final, unless there's any questions. Final news article to cover today. Mirren says trade uncertainty makes Fed rate cuts more urgent. Federal Reserve Governor Stephen Mirren said recent trade tensions have increased uncertainty in the outlook for growth, making it more important for policymakers to lower interest rates quickly. There's now more downside risks than there was a week ago, and I think it's incumbent upon us as policymakers to recognize that should get reflected in policy, Mirren said Wednesday during an event organized by CNBC. Higher uncertainty around trade policy between China and the US have introduced a new tail risk, he said. I wouldn't say that I want even lower rates now than I did a week or a month ago, Mirren said. However, with the change to the balance of risks, I think it becomes even more urgent that we get to a more neutral place in policy quickly. Businesses across the semiconductor supply chain are bracing for a full-blown trade war after President Trump threatened to impose an additional 100% tariff on China last week. The move follows restrictions imposed by the Asian nation on rare earth mineral exports, to which the US responded it would also consider controls on the sales of any and all critical software. Even before the latest escalation in trade war, Miriam favored lowering the Fed's benchmark by an additional 1.25 percentage points by year's end. The median projection from the Fed's 19 policymakers was for 2 more quarter point cuts in 2025. On Wednesday, he said expecting 2 more rate cuts this year sounds realistic. Fed Chair Powell said on Tuesday, we talked about that. Mirren has replied, we talked about that. Severe FOMO. Mirren has faced criticism for his decisions to take a leave of absence from his post as chair of the White House Council of Economic Advisors for a temporary role at the Fed, sparking concerns about his independence from the Trump administration. On Wednesday, he said appointing CEA chairs to the Fed was a practice that long predates Trump's time in office. Let's do 2 more. This one and this one. HUD issues layoff notices targeting fair housing staff with deep cuts. Fair housing staffers who investigate claims of housing discrimination at field offices nationwide were among the hundreds of HUD staffers who received layoff notices. Hundreds of staffers at the U.S. Department of Housing and Urban Development received layoff notices late Friday afternoon as the Trump administration made good on threats to fire workers during the federal government shutdown. The largest cuts were concentrated in the agency's Office of Fair Housing and Equal Opportunity, the division that investigates claims of discrimination and abuse. Nearly 100 equal opportunity specialists who investigate fair housing complaints received reduction in force notices at field offices around the country, according to documents seen by Bloomberg. Layoff notices went out to field offices in Atlanta, Baltimore, Boston, Denver, Fort Worth, Miami, New Orleans, and Philadelphia, and more. According to two staffers at HUD who requested anonymity for fear of retribution, the entire fair housing staff at two of HUD's 10 regional offices got notices. Denver, which oversees Colorado, Utah, Wyoming, North Dakota, South Dakota, and Montana, and San Francisco, California, Nevada, and Arizona. Five other regional offices also saw deep cuts to fair housing staff. Last day will be December 9. HUD is implementing a reduction in force to align our programs with administration's priorities and the appropriations available to the department. HUD said in a statement, the agency did not immediately respond to questions about the cuts. The Trump administration's approach to fair housing enforcement has been a subject of fierce debate under the Housing Secretary Scott Turner, with staffers warning that the government is neglecting its duties. A whistleblower disclosure filed in August by four HUD civil rights attorneys raised alarms that HUD staff cuts and policy shifts were decimating the agency's ability to investigate discrimination complaints and enforce fair housing laws. The Office of Fair Housing and Equal Opportunity has lost nearly 70% of its attorneys since January, according to the letter. In September, HUD issued a memo outlining a shift in its approach to fair housing. The agency will not prioritize claims over policies that are not explicitly discriminatory, but nevertheless result in harm against people in protected categories. For example, cases that involve lenders restricting or denying mortgages to whole neighborhoods, a practice known as redlining and an engine for racial segregation, will no longer take priority. Job cuts announced on Friday targeted more than just fair housing. Layoffs also hit the division of the agency that distributes and administers billions of dollars in block grants for affordable housing and community development. More than 100 staffers that oversee public housing and Indian housing got notices, including more than 25 employees whose job is to inspect rental housing, as well as 50 staffers in the office that includes Federal Housing Administration, an agency that generates billions of dollars for the U.S. government by underwriting mortgage loans for homes. Several affected staffers say that they hope that the notices are merely negotiating tactics. RIF notices also went out in March for field policy and management offices, closing many of them, but HUD ultimately did not act on them. Okay. And this one. Affordable housing left vulnerable after Trump fires building inspectors. The U.S. Department of Housing and Urban Development cut its inspection team 2 weeks after a public housing building partially collapsed in Bronx. A gas explosion in public housing project in Bronx caused the chimney of the 20-story building to collapse on October 1, sending a shower of bricks and debris tumbling to the sidewalks as residents dashed for the exits. Nobody was injured, and 2 weeks later, with a temporary boiler in place, tenants are returning to their homes. Federal law requires all government-subsidized properties, including Mitchell houses in the Bronx, to undergo inspections on an ongoing basis, but it's not clear when this property was last visited by a federal inspector. On the same day as the near disaster in the Bronx, the federal government shut down, sending federal housing inspectors and their data on furlough. The answers may not come to light anytime soon. On October 10, as part of thousands of layoffs by the Trump administration during the government shutdown, the U.S. Department of Housing and Urban Development laid off its entire team of building inspectors. More than 90 staffers at the HUD's Real Estate Assessment Center were let go. Okay. Let me just skim through this. A lot of feedback mechanisms are being dismantled, said David Gonzalez Rice, a senior vice president of public policy at the nonprofit National Low Income Housing Coalition. It's one more place where the public is losing a resource that makes sure we're getting value of our tax dollars and making sure the people being served by our programs are well served. Federal building inspectors are responsible for a sizable portfolio of affordable homes. All told, more than 5 million housing units, including public housing and subsidized multifamily units, as well as privately owned apartments occupied by renters with housing vouchers. Inspectors look at about 12,000 properties per year, testing smoke alarms, plumbing fixtures, electrical outlets, door locks, circuit breakers, and more, while also checking for lead paint, mold, pests, and other hazards. While most of this work is done by contractors, staffers within HUD's schedule coordinate, review, and upload those inspections, reserving the most challenging reports for internal staff. One of the companies contracted by HUD to perform inspections did not respond to a request for comment about whether this work is continuing. Given the deteriorating conditions of America's aging stock of affordable housing, the work of inspectors is vital, but they were stretched thin during the pandemic and still face a backlog. Some affordable housing properties haven't had an inspection in more than 5 years, even though the maximum limit between inspections is 3 years, with more frequent checkups for poor performance. Quote, like with any maintenance, particularly with older buildings, if you're not actively checking and resolving issues as they come up and conducting oversight and quality controls for the people who do those inspects as well, you just set that conditions for more of those issues to come up. Even before the reduction in force notices went out on Friday, public housing authorities that liaise with HUD's inspections division expressed concerns about staffing levels, outlines significant obstacles that housing authorities are finding in securing approvals for action plans, processing appeals or waivers, getting answers to technical questions. Inspection scores are supposed to be public, but they're no longer accessible. With these cuts, housing authorities fear that HUD may suffer a severe deficit of expertise in dealing with problems such as lead-based paint or mold, according to I'm not going to pronounce it. Or worse, a system designed to prevent a disaster could come up lacking. The New York City Housing Authority says the investigation of the Mitchell Houses accident is ongoing. The incident follows another partial building collapse at a public housing project in the Bronx 2 years ago. While a failure of this magnitude indicates a lapse in safeguards, it also spurs the government into action. In the wake of a fire or another calamity, federal inspectors will normally pull the files on the property and begin lining up emergency assessments for buildings of similar stock or age to rule out the systemic deficiency. NYCHA is under federal monitorship, so the Mitchell Houses collapse may have triggered an emergency response. An NYC spokesperson cited 2 municipal reviews. But the staff who routinely do this work for properties around the country received notice that their last day will be December 9. It's not possible to detect every warning sign in time, but if the government is still shut down once the current slate of checkups is completed by contractors, the agency plans out inspection 20 days in advance. There won't be anyone at headquarters to schedule more. HUD is required to ensure that owners mitigate life-threatening deficiencies. Those are deficiencies that have to be mitigated within 24 hours. There's a concern that HUD may not have the capacity to ensure that they're following their statutory requirements. All right. On that note, thank you very much, everybody, and I'll chat with you all next time. Take care.